Today we're covering how trusts and estates function as clients for the Series 65 exam. The exam will test your ability to distinguish between revocable and irrevocable trusts. A revocable trust, also known as a living trust, can be changed by the person who created it, the grantor, at any time during their life. For exam purposes, remember that assets inside a revocable trust are still considered part of the grantor's estate for tax purposes. This means the income is taxed to the grantor, and the assets are subject to estate taxes upon the grantor's death. An irrevocable trust, on the other hand, cannot be easily changed once it's created. The grantor gives up control of the assets. The key exam takeaway here is that assets in an irrevocable trust are generally not included in the grantor's estate, which can be a major advantage for avoiding estate taxes. The trust itself or the beneficiaries will be responsible for taxes on the income generated. A major trap on the exam is confusing the roles and responsibilities. The grantor creates and funds the trust. The trustee is the fiduciary who manages the trust's assets for the benefit of the beneficiaries. The exam will expect you to know that the trustee must act in the best interest of the beneficiaries, following the instructions laid out in the trust agreement. This is a fiduciary duty. Be prepared for questions that test the Uniform Prudent Investor Act, or UPIA, which governs how trustees must invest trust assets, focusing on the overall portfolio, not individual investments. The exam might present a scenario where a trustee makes a single risky investment. This is not necessarily a violation if the overall portfolio is managed prudently. Regarding estate planning, you'll need a basic understanding of how assets are transferred at death. Assets in a revocable trust avoid the court process known as probate, while assets passed through a will typically go through probate. A testamentary trust is a specific type created by a will and only becomes active after the grantor's death. These assets are subject to probate. Finally, let's touch on the generation skipping transfer tax, or GSTT. This is a federal tax on assets transferred to beneficiaries who are 2 or more generations younger than the donor, such as a grandchild. The purpose of the GSTT is to prevent wealthy families from avoiding estate taxes for multiple generations. For the exam, know that this tax is separate from and in addition to any applicable estate or gift tax. There is a significant lifetime exemption amount for this tax, but any amount transferred above that is taxed at the highest federal estate tax rate. A simple way to remember the core difference between the two main trust types is this phrase: revocable is reachable, irrevocable is untouchable. This means the grantor can reach back into a revocable trust, but assets in an irrevocable trust are untouchable by the grantor, and often by creditors and the estate tax man as well. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.